It is May 2015, question number 2, cow. The risk and return characteristics of the two assets are shown below. We have company A and company B. Returns are given there. Standard deviations are given there. Uchumi Investment Company plans to invest 80% of its funds available in A and 20% in B. The board of directors of the company believe that the correlation coefficient between the returns of these assets is 0.1. Is 0.1. So you're told required, we give them the expected return from the proposed portfolio of asset A and B. I know you guys are so good in this, so I'll go directly to do the question without discussing it, because I know you guys are so good at this. You guys are so good at this, that one I know. So when they tell us to give them expected return of a portfolio, expected return of, you can write this in full. Expected return of a portfolio is a combination of investments. So they tell us to give them expected return of a portfolio. They want us to combine returns of the other securities together. So then expected return of a portfolio will be the same as what here somebody expected returns of A plus expected returns of what here B. But now remember, we are not going to invest in A 100%. No, we have the weights. So we must attach the weights here. So this is weight of A plus weight of B there. Expected returns of B like that. I don't know whether we guys are able to remember this formula. Expected return of a portfolio. We are putting things together. We are putting things together. We are putting things together. So in this case here, the weight of A. Have they given us the weight of A? Yes. They've told us that the weight of A is 80%. 80%. So then this will be 0.8 times expected return of A. Expected return of A, I can see up there, we have 12%. Plus weight of B. What is the weight of B? What is the weight of B in this question? The investment percentage in B is 20%. So 0.2 times expected return of boy. Expected return of boy is 20%. I hope you're able to see the expected returns given on that table up there. Right? So are you able to give us, in this case here, the expected return of the portfolio? 13.6. Thank you very much. So 13.6 what here percent is the expected return of the portfolio. Portfolio is basically an amalgamation of securities. We're putting those returns together. Then they want us to give them the combined standard deviation. They want us to give them the standard deviation of the portfolio. What they want us to do in Roman 2, they want us to give them the risk of the portfolio, and the risk of a portfolio is normally calculated using the standard deviation. So they want me to give them the standard deviation of the portfolio, of which I'm so sure there are very few students among us who can be at a position of remembering that formula of standard deviation of a portfolio. One thing that I know my students will never forget is the big square root. The big square root. All right. So we have here weight A, standard deviation A, plus weight B, standard deviation B, plus twice the covariance of AB. And then we have the weights. But again, remember that these two must always be done what here? They must always be squared. Those two must always be squared. Those two must always be squared. Yes, long formula, yes. Have we been able to write down this formula? Have we been able to write down this formula of standard deviation of the portfolio? Yes. But you realize that the examiner has not given us covariance. When the examiner doesn't give us covariance, what are we supposed to do? When the examiner doesn't give us covariance, when the examiner gives us correlation, what are we supposed to do? Two things. If I'm the one really doing this, this is what I shall do. This is what I shall do. If I'm the one doing this, this is what I shall do. If I'm the one doing this, this is what I shall do. I will come here and rewrite the standard deviation of the portfolio, but this time around using what here correlation in. So every other thing will remain the same. Every other thing will remain the same. Every other thing will remain the same, except for the fact that now I'm coming to introduce, instead of covariance, I introduce correlation. But now remember, when you introduce correlation, you must bring on the board, on the table, you must bring the respective standard deviations now. So you must bring standard deviations here. So we have here standard deviation of A, standard deviation of B, and then of course the weights must always remain. The weights must always remain. The weights must always remain. So remember that correlation is a natural partner of the standard deviations. 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 So please remember this is supposed to be R. It's only that my handwriting is very bad. This is supposed to be R for correlation. For correlation. It's supposed to be R for what here? For correlation. Thank you so much. Now, ladies and gentlemen, please listen here. Listen here. Thank you very much. So then what we're supposed to do, I can see my home, you have really mastered this formula, which is very good. Now what we're supposed to do here is to come and really plug in the figures. So come here, they give us the standard deviation of the portfolio, which will be the square root of. Are you able to see the weights? Are you able to see the weight of A? Of course, ladies and gentlemen, the weight of A is 0. What here? The weight of A is 0. The weight of A is 0. The weight of A is 0.8. Has this examiner given me the standard deviation of A from that table given up there? Are you able to see the standard deviation of A? The standard deviation of A. You guys are not moving as fast as I thought you would be moving, really. You guys are not moving that first. You guys are not moving that first. So the standard deviation of A, if you're keen enough, the standard deviation of A that you are seeing there is supposed to be 3. You can choose to ignore the percentage. After all, in portfolio management, we always ignore the percentage. So just talk of 3. Plus weight B is 0.2. How about standard deviation B? Standard deviation B, I can see there is 7. So even if you have to put 0.07, no problem. But you see, because of the squaring, you're going to get very absurd figures. Plus twice, have they given me the correlation coefficient? Have they given me the correlation coefficient here? R, they've told me that R correlation is 0. What here? 0.1. Is it 0.1 or 1? Is it 0.1 or 1? It is 0.1. It is 0.1. So then we have 0.1 multiplied by these respective standard deviations 3 and 7, right? Multiplied by the weights. The weights, of course, we remember them. We have 0.8 and 0.2 like that. All right. So here now you need some kind of audacity, some kind of confidence to be able to put in these figures in your calculator and give us out there a good answer. So if I were you, I would put a big square root and then I open a bracket in my calculator. I say 0.8 squared times 3 squared plus 0.2 squared times 7 squared plus 2 times that, times that, times that, times that, times 0.2, close the bracket. And then I say equals. Then I say equals. So in this case here, what are we going to get? Marietta inadvertently has put on her video. So you've gotten to see Marietta. Yes, great. 2.89. 2.89. I'm getting here 2.89. I'm getting here 2.89. Is that there are very few students who have gotten that answer? Very few students who have gotten that answer. Very few students have gotten that answer. Very few. David, Sylvia, James Kia, Carol, Atieno, good. But you see, that is a very small number. That's a very small number. Winfred, kijana wa Jakoya never disappoints. 2.89. Thank you so much. Thank you so much. Thank you so much. Thank you so much. So, can we assume that all of us have been able to get that figure? Can we assume that all of us have been able to get that figure? Yes. Yes. Thank you so much. But you see now why I gave you this question, and this is something that many examiners have used to punish our students severally. Not once, not twice, severally. These examiners at times, in this case here, they can be bad. They can be sadist. So you get an examiner, this examiner will come, will give you A, will give you B, This guy will come and give you standard deviation. He'll tell you this is 8%. He'll tell you this is 7%. Great job. He'll come and give you investment amount. He'll tell you this is 300,000. This is 700,000. Those are the investment amounts. Right? And then he'll come and tell you that A and B are negatively, perfectly correlated. They are negatively, perfectly correlated, right? And then, of course, they'll come and ask you to determine the portfolio risk. What is the portfolio risk? Remember here, we have invested the 300,000 in A and the 700,000 in B. The investment amounts, of course, will help me to get the standard deviations. No. The investment amounts will help me get the weights. Thank you, Carol. Will help me get the weights, yes. Will help me get the weights. So I want to see whether there is any student who will be able to run with speed and give us this figure. Will be able to run with speed and give us this figure. Standard deviation. The question is here. The question is here. Cherotich agree. So they simply want you to give them the standard deviation of the portfolio, the standard deviation of the portfolio, the standard deviation of the portfolio, the standard deviation of the portfolio. Great. So I can see Lily. Lily is giving us 2.7 as the answer. 2.7 as the answer. That speed is fantastic. Good speed. Speed in this case here that comes with a lot of confidence. Even if I don't get it right, so what? Even if I don't get it right, so what? Even if I don't get it right, so what? So long as I've tried, so long as I've tried, so long as I have 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 tried. But so far, there is no any other student. Orengo comes and says, no, it can't be what Lily has. It's way much higher. It's 7.3. It's 7.3. Diversity is strength. Kijana wa Jakoya is getting 7.3 as well. So 7.3 Lily has to be correct. You can see what F1 𝐬𝐿 is also giving us, 7.3. Now, ladies and gentlemen, one thing that you are supposed to appreciate is the fact that whenever you are told that securities are perfectly correlated zikombili, either positively, perfectly correlated, positively, perfectly correlated, R is 100%. R is 100%. R is 100%. If it's positive 100%. But if they tell you that securities are perfectly, negatively, or negatively perfectly correlated, it's a perfect relationship, but opposite direction. So R, in short, R here, R is supposed to be negative 100%, which is the same as negative 1. And then now I'll come and pull my big formula. I will come and pull my big formula here. I know that my standard deviation of my portfolio will have a big square root. So we know it is WACA. Like that. Like that. We have twice correlation between A and B. And if you're using correlation, then we must come and attach the respective standard deviations, not forgetting the weights. Not forgetting the weights, and not forgetting that these things, all of them, the 4 of them, they're supposed to be squared like that. So is there anybody who was able to get the weight of A? Is there anybody who is able to get the weight of A out of the 1,000,000 shillings? These guys have, they've taken 300,000 to A. So then the total here is 1,000,000. Total is 1,000,000. Then A, the weight of A will be 0.3. The weight of A will be 0.3. And the weight of B will be 0.7. I hope everybody is able to see that. So then we have here big square root. So the weight of A, you're telling me it is 0.3 times standard deviation of A, which is 8, plus weight of B, which is 0.7 times standard deviation of B, which is 7, plus twice. The correlation between the two is -1 times 8 times 7 times 0.3 times 0.7. Don't forget, please, to square. Don't forget, please, to square these metrics. Always ensure that they are done what here? They are squared. Always ensure that they are squared like that. Always ensure that they are squared. Always ensure that they are squared. Somebody is saying that my board is not clear. Jemima, or have I written down there Pakamoni figures? So is there somebody who is able to, is there somebody who, or you can't see? Or the bottom you can even substitute. You can even substitute. Yeah, you can even substitute. You can even substitute yourself very first. You can even substitute yourself there very first. So let me know whether you have now been able to write. Once you finish, please put a thumbs up. I should be able to see. Great. 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 So Kimathi Nancy is giving me an answer of 2.5. Kimathi Nancy. Do you want to tell me that the guys who had gotten 2.7 were wrong? Do you want to tell me that the guys who had gotten 2.7 were wrong? Do you want to tell me that the guys who had gotten 2.7 were wrong? What could have really made them? Was it 2.7 or 7.3? I don't remember even the answer they had. I can't remember the answer they had. 𝐻𝐴𝐺𝐥𝐻, where did you guys go wrong? 𝐻𝐴𝐺𝐻. Oh, they used +1. Kinya is giving us 2.89. Imagine, I don't know what he has also used. Kinya, Madam Kinya, is supposed to be 2.5. So Lily was the correct one, right? Missed somewhere. Thank you so much. Thank you so much. Thank you so much. Now, the last one before, I was wondering how. The last one before I go to something, continue with my question, the last one is here. Now, this last one is very, very interesting. The last one is very, very interesting. Not many of us will be able to get this correctly. So let me try to write up here. So we have three securities, A, B, C. Then we have, ladies and gentlemen, here standard deviations being given. So this is 7%. We have 10%. This is highly volatile, 13%. And they have given us the weights. So here we have 0.3, 0.2, then we have 0.5, 0.5. All right. And then we have, they've told us here that R between AB is 0.2, R between AC is 0.3. Then we have R between BC, B and C is a correlation between B and C. Correlation between B and C, yes, the correlation here is -0.5. And then now we are required to determine the standard deviation of a portfolio that has got three securities, A, B, and C. That has got three securities, A, B, and C. Unaweza ama huwezani? Unaweza ama huwezani? Unaweza hiyo ama huwezani? Standard deviation of the portfolio that has got how many securities? 3 of them. Wengi hawasemi kama wanaweza ama hawawezani ndio nijue what to do next. Wengi hawasemi kama wanaweza. That is tricky. Pia pala amelia kweli kweli kabisa, hiyo ni hatari. No idea. No idea. Can try. Great. Atino amesema yeye anaweza hiyo. I will take average of correlation. Thanks for that. Lakini uongo. Sharon, uongo. Hapa hakuna averaging. That is hard. They can try. No, having tried. Yes. Combine them. Uongo Bacharia. So, ladies and gentlemen, if this time round the examiner brings 3 securities, I can assure you less than 10% of the students will be able to get it nicely. Less than 10%. 90% under the bus. 90% under the bus. 90% under the bus. Why? Because for 3 securities, this is how my formula will look like. For 3 securities, we have standard deviation of the portfolio. It will be the square root of. So we have in this case here weight of A, standard deviation of A, weight of B, standard deviation of B, plus, ladies and gentlemen, weight of C, standard deviation. These ones must always be squared. They must always be squared. Plus, now straight away, I'll come and pull the correlations. And remember, we always combine 2 at a time. We always combine 2 at a time. So I'll start with the AB combination. So I'll talk of twice. R between AB, standard deviation A, standard deviation B. The weights must be attached. Weight A, weight B. Plus, we go to the next pair. You know, when we are pairing them, it's AB, AC. AB, and then you say, pair A with C. And then lastly, B with C, right? Plus, then we have here now the next pair is this AC. So plus 2, RAC, standard deviation A, standard deviation C. We have weight A, weight C like that. Plus, I wish my space would be enough here, right? Plus the last pair now is this. It will be twice R between BC, right? Standard deviation B, standard deviation C. And then the weights to be attached like that. The weights to be attached like that. Let me in this case here run away from the board so that you guys can write proper formula. When you have 3 securities, ni matata. Examiner akitaka kutesa wanafunzi anauletea 3 securities hii semester akitaka kuwasumbua, ingawa sio rahisi, but just good to be safe. So is there somebody in this particular room who can now come and plug in? Is there anybody who can come and plug in nicely? The explanation, okay. Unasema repeat, adjust the right, okay. Mashida ni mingi. Mashida ni mingi, adjust the right. I hope that helps somehow. At the end, at weight here A. At the end, you at the end, which securities do we have here? It's B and C. So you can only, in this case, you have weight of B and weight of C. The approach is the same, yes. The approach is perfectly the same. So before I explain, could you kindly take a step of faith and substitute, forget about the percentages, substitute the figures inside. 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 Then nikwambie what we shall do next. And nikwambie what we shall do next. And nikwambie what we shall do next. And nikwambie what we shall do next. Okay, so we have Orengo. But you have to low hanging fruit. How comes I can see this thing is not a hard one? It's not a hard one at all. It's not a hard one at all. I'll explain. I will explain. I will explain. I will explain. It's not a hard one at all. It's not a hard one at all. It's not a hard one at all. So first of all, you try to plug in the figures and then give me the final answer. Give me the final answer. Leave the other bits of explaining to me. Leave the other bits of explaining to me. According to Zoom user, and this Zoom user is very aggressive. I've never gotten to know the name. Zoom user. Is it positive correlation? They have been given, yes. You know, when you see a number like this, without any sign, that number is positive. That number is positive. So it's positive correlations. Apart from BC, you can see BC, we have a negative one, minus 0.5. BC is negative 0.5. BC is negative 0.5. So before I repeat the explanation, is there anybody, even if it's one or two or three or four students who are able to give us, this figure? Two minutes. Jackie 5.9. Kendi anasema within 2 minutes tutakuwa na answer. Let me suppose it will be the correct answer. Let me believe it will be the correct answer. Let me suppose it will be the correct answer. Macharia, very aggressive young man. 11.56. Just give us an answer. Even if you are wrong, so what? Even if you are wrong, so what? Today, their students are not hearing at all. Good students like Nancy. 6.89 from James Kia. From James Kia, 6.89. $6.34 F1G F1G, the lady who believes that, no, some things I should not say when you are recording. Caro 6.89 from Mary. Sherilyn, 6.89 seems to be the most popular. 6.89, Macharia, today you are offside. You are alone there, Lone Ranger. You want to score the goal when you don't even have a goalkeeper around, right? Right. So then weight of A, standard deviation of A, this already I have. So the weight of A is 0.3. Standard deviation of A, I have that, squared. Plus weight of B, standard deviation of B, what do I have here? So weight of B is 0.2. Standard deviation of a ball is 10, squared. Weight of C is 0.5. Standard deviation of C is 13. Then we have 2 RAB. RAB is 0.2, right? We have standard deviation A, standard deviation B. Standard deviation A, standard deviation A, standard deviation A is 7 times standard deviation B, which is 10. And then multiply this by the 2 weights. So the 2 weights, what do we have here with the 2 weights? It is 0.3 and 0.2. 0.3 and 0.2. 0.3 and 0.2. Plus 2 RAC. RAC, I know the RAC is 0.3 times the standard deviation A, standard deviation C. So we have standard deviation A, ladies and gentlemen, standard deviation A is 7. Standard deviation C is what here, 13. Times now the weights. Weight of A is 0.3 and then 0.5, like that. Plus, come here, 2 RBC. RBC itself is negative 0.5. Multiply this by standard deviations BC. Standard deviations BC, we have 10 and 13. So we have 10 times 13 plus weight, not plus but times weight B and C. So times weight of B here is 0.2 times weight of C, which is 0.5. I'm so sure most of us may have missed out this negative. I don't even have to remember it. What I need to do is just to get my calculator and try to press all these at once without even the square root at first. I can leave the square root out. So I'll press there 0.3 squared times 7 squared plus 0.2 squared times 10 squared plus 0.5 squared times 13 squared plus, then I pick all these. Don't forget this negative. And then whatever I will get will be the variance. So I need to come and get the square root. I need to come and get the square root. I need to come and get the square root. I need to come and get the square root. So Wright is asking whether we don't convert to decimal. No, for these standard deviation percentages, you don't need that. You just work with them the way they are. Even if you were to put them in form of decimals, you will end up getting the same answer like ours, and you'll have strained more. You'll have strained more. So, ladies and gentlemen, where are we really? Where are we really? Where are we really? So the correct answer I'm being told by Sharon is 6.79. Nancy Kimati Batimba umekosea. Tena inafaa ikuwe hapo 6.7, 6.8. Inafaa ikuwe katikati hapo. Katikati hapo. Katikati hapo. Inafaa ikuwe katikati hapo. So are we together really? Before I start explaining the formula, I would want to take 2 minutes to explain the formula. I would want to take 2 minutes to explain the formula. So we are together. Amidst the problem, ladies and gentlemen, that this formula is very long. Students are struggling to understand it. Bright students. These are bright students, all of them. They're struggling to master it. So if I go to an exam, I see them giving me many securities like this. And then they tell me that the investor has gone for what? The investor has gone for a portfolio. And then they make the mistake of asking for the portfolio standard deviation. They make a mistake of asking for the portfolio standard deviation. Then this is what I'll do. I'll first of all come and remember that even if there are many, we must pair these securities 2 at a time. 2 at a time. So here we are not accepting polygamy. It is 2 at a time. So I'll pair, first of all, it's AB, A and B, and then we have A with C, right? And then we have a B with C. This is like salvation. It's one way. It's forward ever, backward never. Forward ever. So you can't say BA. So it's AB, AC. You're walking like that. And then B, C. You can't go back. You can't tell us CA. All right? Now, ladies and gentlemen, the moment I have these pairs, I'll remember that I need their correlations, right? I remember that I need their correlations. All right? And then, of course, if it's correlation, then I'll come and add their respective what? Standard deviation. This is AB. So I'll take standard deviation A, standard deviation B. And then I add the weights. So we have weight A, weight B like that. All right. The same case with AC. So for RAC, I know the next thing will be for me to come and add the standard deviations. So I'll talk of standard deviation A, standard deviation C. I'll come and talk of weight A, weight C like that. So RBC, I'm putting on board the BC parameters. So BC parameters, I start with the standard deviations. So standard deviation B, standard deviation C. And then now we have the weights like that. The weights like that. Weight B, weight B, weight C. And then, of course, I know that all these must always be done what here? Multiplied by 2 like that. All of them must be multiplied by 2. And then now, armed with that knowledge, I know that my standard deviation of the portfolio will be the big square root. Very big square root. Very big square root. Very big. I have 3 securities. So I'll start with worker. I will start here with worker. I don't know that they're able to see down here. So I'll start there with worker. Of course, this has to be squared. And there are 3 of them. So we have a WB, standard deviation B squared, plus weight C, standard deviation C squared. And then I'll come and pull the associations, put them here. Put them here. So we have here plus 2. So I'm pulling this. RAB, standard deviation A, standard deviation B, weight A, weight B. Plus blah blah. I add this plus. I hope that helps. I hope that is helpful. I hope that is helpful. I hope that is now helpful in some way. In some way. So the students who are saying that they would want an average, no, don't use an average here. Don't use an average here. This is a very important thing for you. 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 Now, repeat again. Repeat again. Repeat again. I would prefer you watch Irene the video now. Now we'll watch that video in the evening. Perhaps not even come, Irene. Perhaps not come. Perhaps not come. Now, I would want to comment, ladies and gentlemen, on one thing. One thing in this question that we are doing, this part 4, May 2015 part 4, I just want to comment on that one, part 4. Suppose the correlation coefficient between A and B was -1. Demonstrate how Uchumi Investment Company could invest its funds in order to obtain a zero-risk portfolio. This Roman 4 is something in this case that is very important. I can see Mama Chemu here asking a very important question for us. She's asking, what if in this case here we were given covariance now, not correlation? Not correlation. If I was given covariance, you know, covariance eats up this gap. So if I was given covariance, I would have come and taken a covariance of AB for everything there. Let me repeat this. Let me repeat this. So when I'm given covariance, what do I do? Whenever I'm given covariance, what do I do? Whenever I'm given covariance and they want me to give them a standard deviation of the portfolio, this is what I do. This is what I do. So we have in this case here the worker squared, plus in this case here there are 2 only, WB, standard deviation B, there are 2 only. All right, plus twice the covariance of AB. Now you don't bring standard deviations. Covariance doesn't work with standard deviations. No. Once I have that covariance of AB, the only thing I need to do is to come and attach what here? The weights. So I don't want to really be labor there. I don't want to be labor there. Right? Yeah, I don't want us to talk about a lot about this. Now this is water under the bridge. That's water under the bridge now. It's water under the bridge. Now I'm doing something very important here called the concept of full diversification, the concept of what here somebody, zero risk. When they talk to us to give them, what are they requiring of us? They want us to demonstrate how Uchumi Investment Company could invest in order to obtain how do we invest in order to get portfolio risk being zero. They want you to give them the weights. We call them the optimal weights. We call them the optimal weights. So for optimal weights, is there anybody who can give me the formula of getting weight of A? This is very common. Optimal weights. How should they invest for optimal weights? So weight of A will be equal to who? I would want someone to be very creative there and give me that formula. Optimal weight of A. Optimal weight of A. Optimal weight of A will be equal to something. Optimal weight of A will be equal to something. Variance of B. I like what Lilian is saying there. Lilian anakaa alikamata hii kitu. Amejua ukiulizwa weight of A lazima uanze na variance, isn't it? So we have here variance, and it can't be variance of A, it will be variance of B. Minus covariance between what here? AB. All over. Now give me the denominator. All over. Divided by variance of A, variance. Great. So we have here variance of A plus variance of B. Minus, now because there are 2, twice covariance of AB. This is the formula for getting optimal weights. The formula for getting optimal weights. The formula for getting optimal weights. Keeping it each, well done. Well done, but now you see here, do we really add or subtract? Do we really add or subtract? So you're doing part 4. We are doing part 4. We are doing part 4. Suppose the correlation coefficient between the returns of asset A and asset B is -1. Demonstrate how Uchumi Investment Company could invest in funds in order to obtain. So how do they invest? How much do they put in A? How much do they put in B? They're asking you to ascertain the optimal weights. So we want to give you a minute. We see how you're going to battle out with this giant. It has been tested many times. It has been tested many times. It has been tested many times. Can somebody help my sister Nancy? They are very fast. Oh, Evelyn Atieno has a queue. Let me leave for now. So sorry, you guys should be able to request your employers to understand the importance of you getting personal development. You can imagine I'm not going to do anybody's exam and I'm able to get a leave. And I'm not going to do anybody's exam. All right. Now, two things. This examiner has not given me covariance. What he has done is to give me correlation. So when he gives me correlation, I'm a bright chap. I know when he gives me this correlation, I know that to get covariance between the two, I will take the correlations and add the standard deviations like that. Ama namna gani? Witapata covariance, what do? When you want to get covariance from the correlation, this is normally what we do. So what I'll do in this situation is to get this covariance myself. So the covariance between AB will be equal to R. Have they given me R? Have they given me R? Variables, I don't understand that. Have they given me R? Yes. Plus 0.1. So it is 0.1. Thank you so much. Have they given me standard deviation? Have they given me standard deviation of A? Is the question, have they given me standard deviation of A? 3. Standard deviation of B is 7. So then this will end up giving me what figure somebody as the covariance. Covariance between A and B. Covariance between A and B. 3, what do you mean? Oh, okay, you're giving me the first one. Now we are at covariance. So they're telling me that covariance is supposed to be 2.1. Covariance is supposed to be 2.1. So could you kindly go and plug in these figures? Now we have everything. Try plugging in the figures, and then you give us weight of what here? The weight of A. Try plugging in, and then you give us the weight of A. How I wish I had very, very good students like the ones I had in the morning. I think when people take lunch, so Sharon is saying that that R is supposed to be -1. I don't know who's telling me the truth. Let's use what we have been given. Please remember, what have they given us? Let's use what we've been given. What have they given us here really? What have they given us in this question? It's -1. It's -1. We are wrong. Or rather, I'm wrong. The R here is -1. I don't know where I got the 0.1 from. The R is -1. I'm wrong. This is -1 times 3 times 7, which at the end of the day will give me what here minus what? Like the one that Sherilyn had gotten, -21 like that. So then come here. So here it's about standard deviation of boy. Standard deviation of boy, I know it's 7. So 7 squared minus the covariance itself, which is minus 21, all over the standard deviation of A, which is 3, but now squared, plus 7 squared minus twice 2, the covariance, which is minus 21. So hapo unaenda pole pole, utupatie numerator. Give us the numerator first. Mwendo ni wa aste, give us the numerator first. Mwendo ni wa aste, give us the numerator first. The numerator alone. Numerator alone. Makori says it's minus 2.1. Is it, Makori? Remember 3 and 7 is 21. 21 minus times minus 1, Makori, no. No. Remember R is minus 1. R is minus 1. Makori is still insisting on minus 0.1. Makori, read Roman 4. Read Roman 4 of that question, Makori, please. Read Roman 4 of that question, Makori, please. Roman 4, they have given us the correlation of minus 1. Thank you so much. At least you have been able to see very fast. Thank you so much. Now, ladies and gentlemen, then what we'll need to do very first, we shall come here and get the numerator. So what do you have for your numerator? Numerator alone is 70. I'm being told that numerator alone is 70. How about the denominator? 100. So meaning that weight of A is 0.7. 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 Weight of A is 0.7, isn't it? Weight of A is 0.7. So if weight of A is 0.7, then what do you suppose is the weight of boy? What is the weight of boy? What is the weight of boy? We know that the two weights must always add up to 1. So weight of boy becomes 0.3. So forget about everything else in this question, but never ever should you forget the formula of getting weight of A. Never forget the formula of getting weight of A. I'm so sure you guys now are very good at that. I'm so sure that you guys are very good at that. Marietta is still stuck with 2.1. Marietta is still stuck with 2.1. Marietta doesn't want to read Roman 4 of the question, where R is given as minus 1, not minus 0.1. R for Roman 4 is given as minus 1. Read Marietta that one, you'll be able to appreciate what I'm talking about. You shall be able to. Yes. Great. Fantastic. Okay. Great. And the same concept, ladies and gentlemen, has been tested not once, not twice, not thrice, many times. It's an area that examiners know students have a weakness. Like it was brought in May 2014, question 1, boy. Can you kindly attempt that question? May 2014, question number 1, boy. Just attempt that one. May 2014, question number 1, boy. Please attempt that one. May 2014, question number 1, boy. The concept of what here? Optimal weights. The concept of optimal weights. Is there anybody who is able to attempt that very fast? Okay. Is there anybody who is able to? Or they don't have the question. Is there somebody who can post that question here? Post it here on Zoom. Post the question here on Zoom. Post the question here on Zoom. It'll be very important. Already they have gotten, yeah, it is there. James Kia has already been able to post it. May 2014 question number 1B. I can see Mary Achoki is now becoming a superstar. Mary Achoki has gotten 0.84 and 0.16. Yeah, rounding off errors. I can see Millicent. Thank you very much, Kenya, for taking your time to type that. That is so good of you. You're a leader. Thank you so much. I even don't know how you are. Is it a picture you took or something? That must be very creative. Looks nice. Kijana wa 𝐐𝐥𝐢𝐧𝐥𝐞 is the most improved student. Kijana wa 𝐐𝐥𝐢𝐧𝐥𝐞 joined us just the other day. I don't even know how it came about our advertisement, but he has really improved. Sheralin leo umenoa leo. With A, Carol amepata 0.15. Rudia haraka haraka. Hata Carol pia. Carol rudia haraka haraka Carol, but I'm so happy because Carol, those days when history will be written by somebody like 10 years from today, Carol atakumbuka mimi nilimfunza kuandika capital C kwa Zoom. History mpaka saizi wengi hamjajua kumute microphones, hamjajua kumute. I'm still training you. I'm still training you. I'm so happy. Now, we've got two securities here in this question. We've got two securities. Two securities. Two securities. So this question, I've got two securities. I can't even seem to get mine. Yes. So they've given us here variance for Y. So the variance, variance is like that. So the variance for Y has been given as 297, 297.6. We have the covariance between the two. XY covariance has been given as 54. And then we have the variance of asset X. So variance of X is 10. Variance of X is 10. Variance of X is 10. It's 21 instead of minus 54. Where is 21? Where is 21? Covariance is 54. Did I take? Covariance is 54 here. Covariance is 54. Is it 54 or negative? Is it negative? Is it negative? Is it negative? Negative, eh? It's negative, I'm being told. Negative 54. Thank you very much. Now, with that, Sylvia, then I should be able to get the weight of A. With just this, I should be able to get the weight of A. I know the formula here, not A, but X. X. It will be variance of Y. I start like that. Minus covariance between X and Y. All over the total variance. Total variance. Minus, in this case here twice, covariance XY really. So then this one here will be variance of Y is 297.6 minus covariance is negative 54. All right. All over, we have variance of X, which is 10, plus variance of what here, somebody? Variance of Y. Variance of Y, which is 297.6. 6 minus twice, and then now we have negative 54. I'm so sure there are students, even after they have written this nicely, you'll still get somebody coming with the formula and saying squared. You know, already they have squared for us. They're good people. They've already squared for us. They've already squared for us. So now, please, could you kindly give me the numerator? Could you kindly give me the numerator? You see, Raila has not known how to differentiate these questions. You see, this question is very clear. Required. Look at the requirement. The proportions that are extremely risk-averse individual. The proportions are the weights. Part A is very different type of a question. So numerator is 351. Numerator is 351. So the numerator here is 351. All over the denominator, move slowly. Give me the denominator F1 squared. We shall overcome. Don't worry. We shall overcome. We shall overcome. We shall overcome. So then what do we have here as a denominator? It's 415.6. 415.6. So at the end of the day, then what will be the weight of X? What will be the weight of X? At the end of the day, what will be the weight of X? What will be the weight of X? 0.85. 0.85. Now, once I get the weight of X, ladies and gentlemen, as 0.85, then we shall have weight of Y, which will give me what here? Somebody weight of Y. I know it will be minus 1 minus this, 1 minus this, which is 0.15. Now, I believe everybody is comfortable. I believe everybody is comfortable, and I can see great. Now I can see all of us are what here? Comfortable now. Now, in the mock that I'm setting for you for AFM, remember in the mock that I'm setting for you for AFM, you have to do one mock. I have this thought as I get away from this concept. What if, ladies and gentlemen, these guys were to give us something like this? What if they gave us something like this? I'll bring something that's very close to this. An investor is evaluating 6 portfolios with the following characteristics. So they've given us portfolios here 1 to 6. We have portfolio expected return. Then they have given us portfolio standard deviation. The expected return on the market portfolio is 12% with an accompanying standard deviation of 4%. The risk-free rate of interest is 5%. We are required using the capital market line. Now that throws off students 100% down under the birds. Advise the investor on which of the above portfolios are efficient and inefficient. 7 marks. I would want in this case here to pause a little bit to have some students in this case here taking snapshots of this question. And of course, after you take a snapshot, could you kindly in this case here try to ensure that now you solve this very fast. You solve this very fast. Great. Doris Karungare. Thank you so much, WK. I don't know what your name is in full, but you are a good student. We shall use Jensen's here. Thank you. Not many will reason like that. But even after you reason like that, still getting it correct will not be that easy. It won't be that easy. All right. So can I do the question, or do I give you more time to do it? Can I do the question? Can I do the question now? Can I do the question? 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 Yes. I give you 2 minutes. But now I can see yeses are very many. Now, ladies and gentlemen, listen and listen to me very well. Listen, 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 listen and listen to me very well. Listen. Listen here and listen to me very well. Now, we have what we call CAPM, and all of us know what CAPM looks like. We know that CAPM returns. CAPM returns formula is risk-free plus ERM minus risk-free multiplied by beta of the security. Very important. If I want to confuse you, instead of using the word CAPM, I can come and call this CAPM returns. I can call it an SML equation. SML equation. So CAPM equation is also known as a SML equation. Could you kindly, in this case, ladies and gentlemen, please write this, and then highlight this with 𝐎𝐧𝐥𝐢𝐧𝐞 highlighter. First of all, just write. I'll tell you what SML stands for. If I want to confuse you, if I would want to throw you under the bus, if I would want to throw you under the bus, if I would want to throw you under the bus, this is what I'll tell you. I'll tell you, of course, a good student, upon seeing beta values, will be able to know, hey, this SML, even if they're using a very tough term, SML, in this case, ladies and gentlemen, because I'm seeing beta, it must be the CAPM. SML, you're right. This is the security market line. So SML is the security market line. Market line equation, which is this one. So today, ladies and gentlemen, we are baptizing our child another name. We are baptizing our child another name. That CAPM is the same as what here? Is the same as SML. Now listen and listen to me very well. What if the examiner wants you to write what we also call the portfolio equation? Portfolio equation. So remember, under portfolio equation, that we normally use standard deviations here. Standard deviations. So the portfolio returns, the portfolio returns will always be equal to risk-free plus ERM minus risk-free multiplied by standard deviation. I'll talk of standard deviation of S over standard deviation of the market, like that. By the way, after hii ukuwa na beta of the market, if you remember. After hii ukuwa na beta of the market. Ukuwa na beta of the market. But remember that beta of the market is always 1. Beta of the market is always 1. That is why we disregard that beta. All right? So the portfolio returns, known as portfolio equation. This portfolio equation is also what is known as is also what is known as the capital market line equation. Capital market line, CML. The capital market line is a line that is used to appraise portfolio performance. We normally use this CML equation, language of CML, language of SML, when as examiners would want to throw students under the bus. Quite unfortunate, but it is what it is. Would want you guys to be very thorough. When you get outside there as finance managers, I would want you guys, or one day I would want to be very proud of you, right? But the question is, should you be proud of me after you have really ensured that I've failed this paper like 4 or 5 times? It's unfair, but also you have to study. You must study. Great. So then, ladies and gentlemen, please could you kindly, in this case here, go ahead and, because they have told us here to use CAPM, not CAPM, but capital market line. So I would want us to get the capital market returns of each of these securities. There are 6 of them. Let's try to get the capital market return lines, the portfolio returns using this equation. Abracadabra, what do I have? I have my portfolios there. I have my portfolio 1, 2, 3, 4, 5, 6 there. Those are my portfolios. And then, ladies and gentlemen, I would want to get the portfolio returns for each one of them. Portfolio returns for each one of them, and I know the formula, this is how I'm getting the portfolio returns or the CML returns. So portfolio returns or the CML returns. And these CML returns, we are saying CML returns of our security will be equal to risk-free plus ERM minus risk-free multiplied by standard deviation of S divided by standard deviation of the market. So I would want us to get for each security. So in this question, have they given us the risk-free rate of return? Have they given us the risk-free rate of return in this question? In this question, have they given us a yes? Yes. So they're telling us that the risk-free rate of return is here. The risk-free rate of return is here. Risk-free rate of return is 5%. 5%. 5%. So, ladies and gentlemen, here we have 5. So we are starting with 5 as the risk-free plus. How about the expected return of the market? Have they given me the expected return of the market? Have they given me the expected return of the market? 12 minus 5. I'm following this formula. Have they given me anywhere the standard deviation of portfolio 1? Have they given me anywhere the standard deviation of portfolio 1? Have they done that? Have they done that? Have they done that, these guys? Yes, the standard deviation there is 8 for portfolio 1. Aha. The thing that I know most of us will not be able to get very nicely is the standard deviation of the market. Standard deviation of the market. Is there anybody who is able to see the standard deviation of the market? Somebody is telling me it is 4. It is 4. Abracadabra, kuja hapa nipatie figa. Hapa sasa cheza kama wewe. Cheza kama wewe. Cheza kama wewe. Hapana kosea body mass. Wewe hapana kosea body mass. So wanasema kwamba this will be 19. This will be 19. Could you kindly go to portfolio 2? I know that the risk-free will not change. I know that the market return is the same for each security. I know that this risk-free is still 5 times. I know that the standard deviation of the market will not change, but the risk for this will change. What is the risk? What is the standard deviation of 2? What is the standard deviation of 2? What is the standard deviation of portfolio 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 2? Standard deviation of portfolio 2, somebody I'm able to see it here as what here? As 12. As 12. As 12. As 12. Thank you so much. So I know the mistakes students do, they'll have these returns fluctuating. They're forgetting that this formula has got only one benchmark return market, which is what somewhere there, which is 12 there, which is 12, right? So they're telling me that we have a figure of 20. What here, somebody? We have a figure of 26. We have a figure of 26. We have a figure of 26. So can we kindly go to portfolio number 3? So portfolio number 3, we have 5 plus 12 minus 5 times. Do we have the standard deviation of 3? The standard deviation of 3? The standard deviation of 3. Do we have it? Standard deviation of 3. Standard deviation of portfolio 3. It is 6. So 6 divided by 4. Then at the end of the day, I will end up getting what figure? At the end of the day, I will end up getting what figure? Lily tells me 15.5. Thank you so much. So is there somebody who is able to give me the 1 of 4? The fourth return. The fourth return. The fourth return, I'm being given 33. The fifth return. The fifth return. The fifth return. The fifth return. The fifth return is 22.5. The fifth return is 22.5. The sixth return. The sixth return. The sixth return, from Mary is 8.5. The sixth return is 8.5. The sixth return is 8.5. Thank you so much. Now, there is something that I would want to sell to you here today. Hey, listen. You see, they are calling it a CML what? Equation. They are calling it a CML equation. Now, first of all, there is something I would want us to agree. In mathematics, if you are given here 3 times 8 over 4, is this the same as saying 3 over 4 times 8? Quite a silly question, but are they the same? Mayom is saying, is it? Mudoni is saying no. What do you mean? What do you mean? They're supposed to be the same. Yeah, they're the same. In mathematics, they are the same. Why? Because you know this 4 can knock this 2. 3 times 2 gives me 6. And this, because times this 4 can still knock that. They're the same. They're the same. They're the same. They are the same. They are the same. Listen, ladies and gentlemen, listen and listen to me very well. Listen and listen to me very well. We are saying something very important here. We are saying something very important here, that they want us to give them returns of a portfolio of security using this CML. And we are saying that this CML will be risk-free, plus we have ERM minus risk-free multiplied by the respective what-year standard deviations like that. But you see, I'm realizing that this standard deviation of the market is the same for everything down. So it means that I can come and write this equation like this. Talk of risk-free plus, into brackets, we have ERM minus risk-free into standard deviation of it. So I can bring this very comfortably and put it there. No harm. No harm at all. No harm at all. If that is the case, I know that the risk-free is 5. I know that ERM is 12. ERM is 12. I know this is 5. I know that this is 4. And then I'll maintain the standard deviation of the security there. All right? So can somebody give me this? What is 12 minus 5? What is 12 minus 5? Is there somebody who can give me 12 minus 5? What is that answer? 12 minus 5 is 7, eh? So then this would mean that the equation will be 5 plus 7 over 4, standard deviation of the security. It's a straight line equation. It doesn't make sense, Mwalimu, up to now. It doesn't make sense, Mwalimu, up to now. Now, once I have this equation, what I'll do here, I'll come and talk of 5 plus 7 over 4, and then you have told me I use the standard deviation of the security. Who can tell me the standard deviation of security 1? What is the standard deviation of security 1? What is the standard deviation of security 1? 8. Could you kindly give me this answer? Could you kindly give me this answer? Could you kindly give me this answer? You will see this and this is 2. 14 plus 5 will give me what here, somebody? 19. Now that I have an equation, I'll come to 2. I'll talk of 5 plus 7 over 4. I'll have this equation. But are you able to see the standard deviation of portfolio 2? Are you able to see the standard deviation of portfolio 2? It is 12. So at the end of the day, what answer am I going to get? At the end of the day, what answer am I going to get for 2 here? All right. So we have 20 what here? 26. You don't have to follow this. This is useless. So long as you are able to just recall the CML equation, the way it is, the way you are done up there, that's the most important thing. So even if you get a solution somewhere doing it this way, don't crucify yourself. You're doing the right thing. Only that you're trying to use a different method to kill the rat. At the end of the day, what we want to do is to kill the rat. We want, in this case, ladies and gentlemen, to do state capture. I should call it Kasneb capture. Yeah, we capture Kasneb like this, you pass, right? That is the thing, right? So you don't have to bother about this. So could you kindly again remind Mwalimu, this figure is very fast. The CML returns. Is there somebody who can remind Mwalimu the ones that obtained? Leave alone this second. Concept of equation. So CML return, the first one you told me is 19, right? The first one is 19. The second one, 26. The third one, 15.5. The fourth one, 33. Then we have the fifth one. The fifth one, what do we have there? 14.5. Then we have the sixth one, the last one. The last one, 8.5. Is there a 22.5 somewhere? I must have missed out 1, 2, 3, 4, 5, 6. Is there a 22.5 somewhere? The fourth I'm being told is 22.5, not a 3. 22.5, the fourth. The fourth. Not fourth, but fifth. So fifth is the one I'm being told is 22.5. I don't know. I don't know. How about the fourth? The fourth is 33. Great. The fourth is 33. Great. Now, ladies and gentlemen, from there, I will come and capture my expected returns here. column here, expected returns of the security portfolio. Expected returns of the security. Expected returns of the security. Are you able to see these expected returns? Are you able to see these expected returns? Are you able to see the expected returns? Are you able to, yeah, 1925. So we have 1925, 1925, 1632, 1632. Then we have 22.5, 22.5. And then lastly, we have the 8 there. Now, ladies and gentlemen, the moment I've got those two parameters, I now need to come and check the performance. I now need to come and check the performance. So how do we check the performance? So in this case, I would want to come here and calculate the Jensen's alpha values. We need to come here and calculate the Jensen's alpha values. Is there somebody who can remind us the formula of Jensen's? Is there somebody who can remind us the formula of Jensen's? Stop video. Jensen's, yay! They are telling me to come and take expected returns. This one, we take expected returns minus now the CML. Could have been CAPEM. All right, CML, returns of the security. So like, for example, like you saw Mayom long time ago, Mayom was able to tell us that, you know what, if you take this minus this, 19 minus 19, we are getting 0. Meaning that security A is what, somebody? Meaning that security A, is it efficient, super efficient, or inefficient? Inefficient, no. When it's 0, it's at break even. When it's at break even, then we talk of what here, somebody just efficient. It's efficient. It's efficient. The model is efficiently able to predict for us. It's efficient, right? The second one will be 25 expected return minus this, which will end up giving me minus what? Minus 1, which will end up giving me minus 1. So minus 1, how do you call Lillian? How do you call this super efficient really? I'm so sure the mistake here is that you guys have taken 26 minus 25. And the formula tells us that first of all, we need to start with ERS. So it should be 25 minus 26. Which gives me minus 1. Any loss-making security is what here somebody is inefficient. Any loss-making security is inefficient. Is inefficient. I like what Carol is telling me. At times the examiner will tell you to say, ladies and gentlemen, that whether it's overvalued or undervalued. Inefficient securities are overvalued securities. If somebody, for example, today, you're to get out of, I know you are on leave, you are to get out of that pretty chair of yours, right? Go to your spouse, telling your spouse how the class has been very good, and then your spouse tells you that, you know, you are overrating yourself. That will be the worst ever kind of what here statement to come from a spouse. Overrating. You know, if you are overrating, it means that you are really inefficient. Overrated assets are very inefficient. They are overvaluing themselves for nothing. Overrated, overvalued is the same as what here inefficient. So this is the same as what here overvalued. You know, valuing yourself, very good. So let's go in this case here to the next one. So ERS, we have here 16. 16 minus what here, somebody? 15.5, which gives me what figure, somebody there? The positive, isn't it? Positive 0.5. So what does that give us? What does this mean? 0.5, what does this mean to us? It is super, isn't it? It's profitable. Profitable, super, you are super efficient. You are super efficient. So this is super like this. This is super efficient. Super with P, my own, super efficient with P, super efficient. Great. Now from there, ladies and gentlemen, we go straight away, or undervalued, yes. Thank you very much, Orengo, or undervalued, yes. Yani wakati uko undervalued, you are very what here? Efficient. Thank you so much. Thank you so much. Now, please, let's go to the next one. The next one, now you should be able to finish. You should be able to finish this down. yourself slowly, slowly like that.